Hi, this is David Daughtry at Copperwood Financial. I'm doing another Dave's Talk today, and what I'm going to be talking about is interest rates and what our thoughts are on interest rates. I could call it an interest rate forecast, but we don't do forecasts from an interest rate perspective. But I will tell you there are some things that are going around out in the press, that we don't really agree with, and I'll get into why that's the case. So I'll share some of our insights of what we're seeing both in the markets and in the economies around the world. And right now, when you look, most economists are saying that interest rates have to go up because the Federal Reserve, here in the U.S. at least, because the Federal Reserve is going to increase rates sometime later this year. Whether it be June or September or later in the fall, nobody really knows. But the short-term rates probably will be increased from zero. The current level is 0 to 25 basis points, or 0.25%. It'll probably go up to 0.25 to 0.5%, maybe all the way up to 0.75. But that will impact the short-term rates, the money market rates, what the Fed funds rates are between banks. But that may not have that big of an impact on the longer-term rates. What I want to go back to is I want to look, and this is a chart that we look at quite often. If you go back to the 1st of January last year, nearly everybody, in fact there was a survey of 67 market strategists and economists, and they asked them a year from January 1st, 2014, will rates be higher or lower on the 10-year bond? And all 67 said they would clearly be higher, some because at the time it was 3.04%, and people were talking about, well, maybe it'll be at 3.25%, all the way up to, we saw some numbers of 4.5% by the end of the year. Well, fast forward to the end of the year, and you get right here, and you say, okay, so what was it at the end of the year? Well, at the end of the year, in fact, actually, here's where we're at. It was just around 2%. So all 67 of those economists and market strategists were wrong. Why? Because if everybody's on one side of a trade, it nearly never works because there's nobody else to take the other side of that trade. Now what we're seeing is some people saying, well, maybe rates could go down, but the vast majority of them, what they're looking at is they're looking and saying, well, U.S. rates clearly have to go up. Not so fast is what we're saying. Could they, and logically should they? Yes, but logic has had little to do with the way the markets have reacted over the last 5 or 6 years, when you have central banks that are printing trillions of dollars or yen or euro or other currency or pounds, and that impact around the world to the liquidity and what it's doing to both stock markets and bond markets around the world. Let me show you some of that. Let me get here, go back to favorites charts. And if I look back, I'll just go back here. So if I look at the 1-year U.S. 10-year index, what you see is we've gone in the last year from about 262 all the way down. In February we were at 164 up to 2.2. Sorry about that. Up to 2.2. Now we're down under 2%. So the trend has still been going down, even though we've had some times where it jumped up. So that's the U.S. Treasury, and we say, well, 2%, 1.96%. That is really low rate. Well, let me show you. When we look at different rates around the world, what we'll start with is we'll look at, let's look at Germany. So Germany, a year ago, was at about where we were, at a 1.58. They're now down to 0.16, or 16 basis points. A basis point is a 1/100th of a percent. Nearly zero for 10 years. That's ridiculously low, but this European Central Bank is now printing money and buying bonds. And that's what we're seeing in anticipation of that, rates to go nearly to zero for 10 years. That's someone saying that they're willing to lock in money at a negative real return after you adjust for inflation for 10 years. Crazy Economic theory would say that can never occur, but it is. If we look at some of the other ones, even crazier right now, Spain, Ireland, Switzerland, there it is, top of the chart. Everybody loves Switzerland because Switzerland is thought of to be, fiscally responsible. What has occurred because of that is money is poured into Switzerland. So a year ago it was at about 1% rate on their 10-year. They recently, there it is, minus 0.089. So nearly 0.1% negative for 10 years. Absolutely crazy. Absolutely crazy. Let's look at a couple of the other ones over in Europe. So we looked at Japan. Let's look. We looked at Germany and Switzerland. Let's look at Spain. Spain's still a basket case. A year ago they were at 3.2%. Now they're at 1.2. They're a third less than we are, and yet they're a basket case. They still have 15 to 20% unemployment, and their economy is not growing very much. But you've seen them go from 3% to 1.2. What happens when you start printing money out of thin air and throwing it around? Pushes asset prices down or up, and in bonds prices go up and yields go down. If you look around the world, I'll show you another one now this is a little bit less surprising simply because Japan's always had low rates. They've had a tremendous savings rate, and so a year ago they were up at the 0.6%. They're at 0.35, and at one point we're down at 0.20. So when I start looking around the world and I say rates, and people say rates have to go up in the U.S., I look at all of these examples and I say, okay, why are rates going to go up here when Germany has rates that are nearly at zero, Switzerland has rates below zero, Japan has nearly zero rates, and even Spain has rates a third lower than we have. I'm looking and saying institutional investors in those countries will probably start looking and saying, I'm going to take some of that money, and instead of investing at zero, I'm going to come to the U.S. and I'm going to invest at nearly 2% in U.S. Treasuries, no credit risk. Now, along with that, you do have some currency risk, but let me show you what's occurring in the currency markets. Because if I take my money out of euros and I convert it into dollars, if dollars go down in value, then when I take my money back out of dollars, I've lost money. But let me show you what's occurring there if I look at the euro versus the dollar. All right, let me see if I can pull it up here. This is how many dollars it takes to buy a euro. A year ago, it was nearly 1.4. Today, we're at 106, so $1.06. So the currency, the euro has gone down, the dollar has gone up in value. If they come over and invest here a year ago, they would have made 30% just on the currency play. So if I'm a European investor, I can go out of the euro, get a higher yield in dollars, and the dollar goes up at the same time. So I win on both sides. And I think you're going to see more and more of that going forward. Same way if I look and say, what about the yen? Let's see here, get back to that. Japanese yen. And I'll show you here, this is how many yen that you get for a dollar. And a year ago it was right around 100. Today it's 120. In fact, if you look here 3 years ago, we were down at less than 80. So it's gone from 80 to 120, which means is if you invested 3 years ago in a U.S. Treasury, even if you got zero return as far as a yield on that Treasury, which you wouldn't have, you would have got started out at 3%, you have picked up nearly 50% on currency play. So I think what you're going to see is you're going to see more people, institutional buyers especially, out of Japan and out of Europe that are going to come to the U.S. and put their money in U.S. Treasuries, which will replace the money that was being printed and the bonds that were being bought by the Federal Reserve. So I think you're seeing both on the currency side and the interest rate side the impact of the central banks and what they're doing around the world, and that could easily drive money to the U.S. I think that's why the strong dollar, because money is coming to the U.S. I will tell you that that is a very crowded trade, and what I mean by that crowded trade is lots of large institutions, hedge funds especially, are making that trade. They're long the U.S. dollar and they're short U.S. bonds. They may win on the long dollar, but ultimately they're probably going to lose on shorting the U.S. bonds. That will ultimately turn around and will go the other way. And when it does, you're going to see emerging markets do quite well. You will see international do quite well, because the dollar, if it stays strong long enough, it will start impacting companies that are exporting out of the U.S. or have foreign operations. And I think that's going to be a bigger issue down the road over the next 6 to 12 months, probably not over the next 2 to 3 years. I think it absolutely will be an issue, and I think that's why you're starting to see more of the international rebounding right now. And in fact, I'll do one other chart right now, and that is if I look at IFA, which is the international developed. So it takes Europe and Japan and New Zealand, Australia, Canada, those countries. Let me reset that. And what you see is, let's just do year to date and compare it to the S&P. Well, it's up 8.74%. The S&P's up 2. So dramatically outperforming. Where if you take over the last year, the S&P, it was the IFA, the international, was down, and the S&P was up 14. If you look over the last 2 years, even bigger impact, 32 versus 9. So what you're seeing is lately there's really been a turnaround there. So I think part of that is people looking and saying the dollar's getting too strong, but it continues to be quite strong. So that's our thoughts. Our thoughts are that everybody is out there saying rates have to go up in the U.S., and we're saying not so fast. You have to look at a global market, and that global market could clearly indicate that money will flow to the U.S. into U.S. Treasuries, which could push rates down on a long-term for longer-term Treasuries. Short-term money markets and short-term Treasury bills, yes, when the Fed starts raising rates later this year, those will go up, but not necessarily impacting the longer-term Treasuries. So anyway, I hope that was helpful. We'll do more of these, just giving you our insights into what we're seeing in the markets. Thank you.